Welcome to another video, and in this video we're going to be going through the weekly macro themes, which is our institutional report that we publish and put out to clients. And you can see here that we put out 5 different topics each week, and in this one we talked about Chinese property market, a bit of a Jackson Hole preview. I mean, that's almost irrelevant now, but actually the data and charts underlying that are still very, very relevant. QT-Tantrum, and that's the one that we'll be talking about today. Don't let the title throw you off. There's some pretty good stuff in this one. Crude oil and cyclicals. Very interesting segment on cyclicals there, actually. A bit of downside risk on the cards. Anyway, we'll get straight into it. So we're looking for this one. JHQT-Tantrum. Well, you can forget the Jackson Hole part now because that part's irrelevant, but you know, specifically what I was referring to in this is the prospects of the Fed announcing QT, or you know, either officially at the September meeting or perhaps in the weeks leading up to that. I think, you know, probably at this stage it's more likely that they're actually going to go ahead and announce it. And certainly if they were to do that, you know, from their perspective, they've already projected it, flagged it well in advance in terms of, you know, announcing their plans about how they were going to go about passive balance sheet rundown. So, you know, I guess you could preface it by saying that it's passive QT, or passive quantitative tightening, because, you know, the first phase that they're going to do is basically stop reinvesting principal from maturing bonds, and that's going to, you know, sort of automatically or passively reduce the balance sheet or stop it from maintaining at steady pace. So anyway, the bottom line here, forget Jackson Hole, with the September Fed meeting around the corner, the bond market is looking as well set up for another potential yield spike tantrum. And why is that the case? Well, first of all, this is just a little bit of context here. You know, what's at stake if we do get a bond market tantrum? You can see that there's been a phenomenal build-up of assets in yield-related ETFs, and this one's including treasuries, credit, REITs, emerging market bonds, MLPs, dividend funds, ABS loans, munis, UTs, TIPS, and aggregate bond market. Just about anything under the sun, which is, you know, primarily a yield or yield-focused instrument. ETF that's on it is in here, and you can see there that there's been a particular surge in the past year or so. And then what we've done on this chart to the right here is showing the black line is the 10-year bond yield, and the blue line is the 3-month return, you know, average income asset return. And you can see that you know, there can be actually quite substantial shocks to the price. So, you know, with capital shock, should bond prices move, bond yields move rapidly, like during the original the taper tantrum, there was, you know, quite a significant shock there, down almost 8% on a rolling 3-month basis. And to put that in context, you know, yields are still fairly low across the board. I mean, dividend yields are like 2 or 3%, cash yields still around 1 or less. And, you know, the bond yield itself is around, you know, what was that, trading between 2 and 2.5 at the moment, you know, kind of this range that it's been in. So, you know, if you think that you're sitting there just steadily banking your 2% yield, and then you get hit with a 8% capital markdown, you know, I mean, yeah, sure, it did recover, but, you know, the point there is that, you know, it is wise to think of assets in terms of total return rather than just income or just capital. So that's the cautionary. Now, what's the setup? What we've got here is speculative futures positioning and volatility. And on the one hand, you've got the bond market looking you've got speculative positioning looking increasingly crowded long on bonds, and volatility at pretty much record lows. I did update those charts actually, so yeah, you can see here it's come up a little tiny bit, but really not much at all. And same thing for no matter how you measure it, whether you use the the SIBO or the MOVE index, you know, bond volatility is at very low levels. And why that matters, you know, if you go back to that taper tantrum period, yeah, just prior to the taper tantrum, bond market volatility, implied volatility, had gone to extreme lows, and you know, so that's something that makes me pay close attention. And you know, I've got a composite bond market sentiment indicator here, and it is currently coming back down towards extreme bullish levels. And you know, whenever you see it come down to these extreme bullish levels, the risk of a yield spike, you know, the risk of a reversal is, I would say, elevated. You know, just like that period there. And if we go back to the taper tantrum again, yeah, just before that, it was a very extreme reading. So that's probably the key sort of points behind that. But you know, how it plays out medium term, you know, I guess the point that these are short-term market shocks in these cases. Looking at that last chart, you know, there's there's a distinction to be made between the announcement effect and the over, you know, what actually ends up happening medium longer term. So, you know, when you got the taper tantrum here in early 2013, you had that big reaction, and then when taper actually began, that actually marked a peak, a short-term peak in the in bond yields. So, you know, I would say that that's probably something to keep in mind. So, you know, what's going to happen when we get to QT? Are we going to get a spike up? And then, you know, once it's actually underway, maybe it comes back down. And, you know, it's probably actually fair to expect that, because, you know, if you think about quantitative tightening is going to have a, you know, ultimately a tightening effect on financial conditions, then you know, maybe it is reasonable to expect the bond yields would come down at some point. So anyway, that's about it. You know, I've spoken a little bit elsewhere about some of the more fundamental drivers. You know, if you jump on the blog, you'll see posts there about the global cycle and how that's has a really strong correlation with bond yields, and it's already pointing to a bit of a divergence versus fundamentals and bond yields, suggesting perhaps the bond yields are too low at the moment. And I just put a blog post out this morning that looks at the labour market and how tight it is. So, you know, maybe it's not taper tantrum all over again, but, you know, it's certainly set up for, you know, if the Fed were to announce QT, then, you know, it's definitely, the conditions are ripe for it. So that's one of the risks to be keeping an eye on. And I think I will leave it at that. And if you've got any comments or questions, any counter views, please do go ahead and put them into the comments section of the YouTube video. And if you like this video, you'll probably like the other ones as well. So go ahead and check out the channel and subscribe as well.